Hey, welcome to Triathlon Partners TV. This is Ira Koyner, the original IRA. First, I would like to thank our loyal and tremendous viewers and clients, their support. So don't be shy, subscribe, give us a thumbs up, and leave a comment or question. As well, I want to wish everyone a happy Passover. Right now, stock market has been volatile, and although we're not at the lows of the year now, it is significantly lower than when we started the year. And I have seen a ton of articles online. A lot of clients are bringing this topic to my attention. It's about dollar cost averaging. Now, dollar cost averaging is a method of buying more stock when the market goes down, right? And it's a pretty straightforward concept, lowers your average. You take advantage of buying on dips, right? And while I agree with this concept, what you buy when the market dips is much more important than actually buying when the market dips, right? So explain a little bit further. Typically, you're just going to buy exactly what you have in your portfolio, right? The market goes down 10%, you're still going to lose 10%. If the market goes up 10%, you're going to make 10%, albeit you've bought more, so you'll lose a little bit more, you'll gain more, but it's in that same ratio, right? Now, alternatively, I have a product called a structured note. So we're not talking about your current investment, right? A structured note has protection, right, which can limit losses if the market continues to go lower. As well, if the market appreciates, the gains are multiplied by a set number that's greater than one. So this is great for long-term investors. So if the market goes down, on that new amount you bought, you don't lose as much. And if the market goes up, you make more than if you just added to your existing positions, right? So structured notes are issued every month. And I'm going to talk about two of them today, which are available in April 2025. That's this month. Now, the first one is based on the performance of three well-known stock indexes. And you probably own some of these in your portfolio: the NASDAQ 100, the S&P 500, and the Russell 2000. Very common. These are things that you would just go in and buy right now, right? The note is for 3 years. So at the end of 3 years, if all the indexes are positive and have appreciated, the note will pay 1.69 times the performance of the least performing index, right? So if the least performing index is up 10%, then you've actually made 16.9%, right? So you could do the math: 1.69 times the least performing index, right? If the least performing index is negative by less than 30%, you get 100% of your money back. Now, these indexes are very well correlated. And right now, you don't know which one to buy. You might buy a little bit of each. But this is that multiplier and that protection make it that much more attractive. And since you're looking to buy on dips, you think the market is going up. You don't know if it's going to go up tomorrow, in 3 months, in a year, but you think it's going higher. But if the worst performing index is down more than 30%, your loss is 1-to-1. So that's the same as if you bought the index outright. So that's the only thing that's similar. The other two situations are better than what you would have. Now, this is a very important concept, that you want to earn more when the market goes down, right? Earn more on the rally because you've spent all this time worrying, anxious. Oh, all my retirement money is going down the drain. And then when it goes back to where it is, you're back to flat, or you've only made a little bit more. This will actually allow you to make more than just a little. That multiplier actually makes your dollar go further. Now, another note that's coming up this month is on international markets. And I've talked about this one before. It's a very common note. It's based on the performance of the Euro Stock 50 index, 50 large companies in Europe, and an ETF that tracks large companies in Europe, Japan, and Australia. Again, it's very similar to the other one. It's based on the least performing index of the two. And this participation multiplier is 2.6 times, right? Protection is the same. It's 30%. Down less than 30%, 100% of your money back. Down more than 30%, just like owning the index, right? So I hope you found that very informative. But if you're looking at traditional dollar cost averaging, you are doing so because you believe the market will rebound at some point in the future. So why settle for gains that are 1-for-1 with the market when there are structured notes offer terms that are greater than 1-to-1, right? Now, our mission at Triathlon Partners is to engage, educate, and empower our clients to make confident financial decisions that best meet their objectives. Give us a call to discuss how structured notes can benefit you. Our contact info is right behind me and in the video description. Thanks again for tuning into Triathlon Partners TV. This is Ira Koyner, the original IRA, wishing you a blessed day and a happy Passover. Take care.